Maithili Busnarmat, consulting editor, ET now joins in on the show as well. Maithili, good to have you. I just want to start off with your review of the situation as the P-note issue has been fairly sensitive. And aside of that, what the SIT is saying as far as its notification on black money goes.
Well, I have a slightly different view from both Supriya as well as your earlier guest, Mr. Gupta, because, FM has said, yes, he doesn't want to hurt investor sentiment, but he needs to be very clear. What are we talking about? Are we talking about investor sentiment short term, or are we talking about long term? If you're interested in a long-term sentiment, investor sentiment in India, one does need to do something about P-notes. P-notes are like what Mauritius is, because you need to clean up your act if you're bothered about the quality of the money that's coming in, the color of the money that is coming in, the integrity of the money that is coming in. There is no reason whatsoever that foreign institutional investors cannot come by registering with SEBI. If you remember, some years ago, there was a similar panic when the government talked about banning P-notes. And again, the market went haywire and the minister had to come out with a statement saying we're not going to clamp down and SEBI will hasten the process of registration of FIIs. And that's what SEBI did. It did hasten the process. But the very fact is that if some people still feel the need to go in through P-notes, it's like Benami transactions. If you are honest to your intentions, why don't you declare who you are? We have KYC norms for you and me, but when it comes to large foreign institutional investors, we don't have these similar KYC norms. I frankly do not understand the government's absolute panic. We need to look at both the short term as well as the long term, and very often the short term pain is worth the long term gain. So I really do think the government does need to, at least if not come out sharply with a ban, talk in terms of the need to do something to clean up the kind of money that is coming into our markets, because portfolio flows, as we know, are far more destabilizing, especially in emerging markets. So I have a very contrarian view as compared to most market participants, and I'm sure they're not going to love me for this, but that is the reality. For long-term integrity of the market, we do need to ensure that P-notes are completely out of the system, and every FII who wants to come in is able to come in transparently and quickly.
Well, Maithili, that's a view that a lot of Indian participants do have as well. The only question is, if P-notes go away, what about the ease of money coming into India? I mean, whether there are other instruments available to put money into India as easily as or no. So I think that's the fix that maybe the authorities are caught into. But yeah, your point is well taken. However, we can go on talking about this endlessly. I think let's shift focus from this P-note issue to the macro at hand as well. And Kapil Gupta, economist at Edelweiss Financial Services, joins in for this discussion along with Maithili. And Kapil, interesting report. While you're saying that economic turnaround is still uneven, the favorable turn in India's balance of payment is aiding the real economy. Do you think that could be a key trigger going ahead for the next 12 months as well?
Right. So in this report, basically, we are balance of payments is obviously one factor. We are giving a four-factor kind of a framework, which according to us was the prime factors driving this economy down. And it's a good way to track how the recovery is panning out. Not all factors are turning positive at the same time, but some of these factors are turning positive, and one of those is definitely the balance of payment. In particular, balance of payment role is inadequately appreciated, in my view, in the economic downturn. Starting summer of 2011, it was actually the balance of payment shock to India, not just to India, actually across emerging markets, which led to in central banks trying to defend the exchange rate, obviously drain domestic liquidity and tighten the domestic monetary condition, and thereafter a pro-cyclical kind of fiscal stance and monetary stance taken in a lot of emerging markets also triggered the downturn. And there were obviously other factors as well, but this factor was also at play. Now it is on trend basis improving for last 4 quarters. So I think that is one lever which has turned positive out of the 4 factors.
Mr. Gupta, you're entirely right that the balance of payments position is far more comfortable today than earlier. But the fact is that we're at a very low level of equilibrium. Both exports as well as imports are nowhere near where we'd like them to be. So should we take comfort from that really, or should we look beyond the balance of payments and say we need to have that low balance of payments deficit, current account deficit as a percentage of GDP, but with a much higher level of exports, a much higher level of imports?
Right. So, Maithili, you're right, absolutely. If you look at the 4 factors which we are seeing, and probably that will address part of your question. One is the balance of payment dynamics. The second is the terms of trade, which is partly linked to the balance of payment itself. The third factor is the pro-cyclical fiscal and monetary policy, which was, in some sense, forced to be undertaken because inflation was high, current account deficit was high. And finally, the exports downturn also, essentially all these factors, one after the other, had a cumulative effect. Now, if you look back 1 year, or basically if you look at the period from mid 2011 to March 2014, the balance of payment position was by and large under stress. INR was having repeated depreciative bias, repeated capital outflows, first in 2011, then QE tapering in 2013, and all that. So with capital flows recovering, in some senses you can see that it's the global savings which are coming to the domestic economy. Domestic economy in the real basis has to adjust to absorb that extra savings. Either investment rate will pick up or consumption rate will pick up, which means savings will go down. So in some sense, typically when global savings start to flow on a trend basis, something which was not happening in a big way in the last 3 years, that tends to support the domestic economy. Now, you are right that exports lever is not picking up, and I think we are very categorically mentioning that probably this will continue to remain a drag, unlike 2009 recovery or 2001 recovery, in which exports lever was also actually very strong. That's why we are saying that this is not an wholesale, broad-based V-shaped revival in the economy. It is still in pockets. But the factors which are helping is actually global savings flow, which is actually helping the non-bank sources of financing actually picking up, whether it's corporate debt or commercial papers or FDI and so on and so forth. So there are some levers which are kicking in, but a lot more needs to be done, definitely.
As far as global savings come in, yes, global savings are important, but they're always important only at the margin. Ultimately, investment has to be financed from domestic savings. Do you see domestic savings kind of improving at all, because there was a dip? And do you see that improving in terms of financial assets? Is the market going to make a difference, the equity market, bank deposits?
Yeah, so if you look at, and that's where the second factors comes into play partly, that the terms of trade were very adverse in 2009 recovery. If you look at 2009 recovery, the commodity prices, whether it's metal, food or energy prices, they skyrocketed within 1 year into the recovery. And we give comparison in our report 2001 recovery and 2009 recovery, when we said that if you look at two parameters which are typically the gauge of macroeconomic excesses like inflation and current account deficit, then in 2001 recovery, actually they were very benign 3 years into the recovery, and that kept the policymakers very comfortable with the growth recovering. This was very different in 2009 recovery, when current account deficit reached 3 to 4% of level, 3 to 4% of GDP levels 1 year into the recovery, and inflation was in double digits 1 year into the recovery. And therefore, all the recoveries in which inflation is an early cycle phenomena, or even current account deficit worsens, then they tend to be short cycle, because policymakers, especially monetary authorities, cannot allow that cycle to sustain because of the macroeconomic excesses. This time, what we are seeing is that because of very sharp decline in commodity prices starting 7-8 months ago, that is leading to actually improvement in current account, obviously corporate margins, that is boosting real incomes, particularly on the urban side in the economy. So some of the savings are getting built up because of that positive terms of trade shock, which eroded in a big way margins of the corporate and real incomes from 2009 all the way to 2013-14 period. So that's the second factor which is turning, which is giving some breather to the corporates and the households actually.
All right. Thanks very much for joining us and giving us that perspective. I appreciate your views as well on the macro side of things. I just want to address the Chinese market and the tumble that we're seeing there. You're looking at the Shanghai, the Shenzhen market, all of them cracking. Andrew Ferris joins in with a quick perspective on the matter.